opening quote was selected based on a raft of good economic news this week, which prompted some in the financial media to ask, is everything too good? It's seldom profitable to sell on worrying headlines. Instead, we should always be looking for what opportunity these headlines present. Scared money doesn't make money. Smart money knows it has to manage risk and ride the trend until we see evidence of change on the charts. In this week's video, we'll go over the week's economic data, headlines, and the technical strength of the sectors. We'll play a lightning round of Would You Rather to illustrate relative strength comparisons of specific sectors and asset types to the S&P 500, and we'll wrap up with a look at the daily and weekly charts for the week ahead. We open with a summary of this week's economic data and interpretation. Rather than go through each of these items, you can pause the video if you wish to look at them in more detail. The date and the economic reports are listed on the left, with the results in the middle and the interpretations at the right. Every week, we continue to get incredibly strong economic data. As you see with CPI and PPI, which are measures of inflation, there are worries that inflationary pressures will lead the Fed to a policy misstep that could cause a recession. Trade concerns are another overhang for the market, and they're far from being resolved. If anything, the flames were fanned today with Trump's announcement of tariffs on $50 billion worth of Chinese goods. Until these concerns become more visible on the long-term charts, they're simply items to be aware of and to monitor for measurable impact. This chart is from our gauge of ETF technical strength. The time frames for this analysis are weekly and daily, and the scoring methodology weights multiple factors related to outperformance of the S&P, technical momentum, and trend strength. This chart is to help gauge changes in the technical strength of existing investments and to monitor laggards for turning points that suggest opportunity. As you scan through the ETFs, we had incredibly strong retail data this week, and consumer discretionary tops the list in performance. To drive home the point we just made, consumer discretionary has gone steadily higher over the previous 10 days. Chasing at higher and higher prices is often a money-losing trade versus finding a good entry point. Technical health doesn't necessarily highlight the risk of near-term shocks, as we saw today with the XME, or the Metals and Miners ETF. Defense is also exposed to escalating metal costs and the threat of Chinese tariffs on aircraft. Materials show an uptrend that is intact and weakness that is resolving to the upside. Industrials have delivered moderate performance year to date, but dollar strength and trade concerns continue to weigh on the sector. Financials are still struggling with a contracting yield curve, and finally, emerging markets are being repriced based on dollar strength and rising rates. Remember, emerging markets are essentially short the US dollar. Should the dollar reverse, the trend in EM would improve. Now we'll play a lightning round of Would You Rather. In our case, we're going to play Would You Rather Own on the next 3 slides. One of the concepts that we use in ETF selection is relative strength of one investment over another. To do this, we use the ratio of the investment we're interested in to the investment we're comparing it to. If the ratio is positive, price and the moving averages will be going up, and this means that the asset is outperforming what we're comparing it to. So let's start with value. This chart shows the ratio of value to growth. The price line is red and black, and the 50-day moving average is displayed in blue, while the 200-day moving average is displayed in red. You can see that the ratio of value to growth is going down. Looking at RSI in the top panel, which is a momentum indicator of price, the RSI line is stuck under the center line, confirming the downtrend. MACD in the bottom panel shows a new low and a lower high. Let's compare the inverse, or the ratio of growth to value. You see that this chart is simply the technical reverse of the chart on the left. Clearly, the market wants to own growth versus value. For our second round of Would You Rather, we'll look at bonds versus stocks. Here we have the ratio of bond versus stocks. This chart clearly shows the ratio of bonds to stocks is negative, with price below the moving averages. The moving averages are heading down, with the 50-day, which is the faster of the 2 moving averages, on the bottom. Now let's look at stocks versus bonds using the S&P. The ratio is clearly up. meaning the market clearly prefers stocks over bonds. Price looks about to surpass the January high. RSI in the top panel is climbing and held the center line, and MACD is making a bullish cross where the black line crosses over the red line to the upside. For the balanced portfolio adherents, remember that owning bonds is a little like carrying around an umbrella every day, whether rain is in the forecast or not. There's an opportunity cost in a portfolio for those that don't have access to quality weather forecasts for the probability of rain. Furthermore, in the event of significant market shocks, bonds and stocks go down together as all participants move into cash, minimizing perceived benefits of owning bonds in the first, largest, and most violent part of the market downturn. Our model provides a probabilistic forecast, which allows us to more nimbly shift into defensive assets when they are outperforming. Our third round of Would You Rather features the ratio of emerging markets to the U.S. stock market. We're using the S&P 500 ETF. The ratio had been making progress throughout 2017 and has since taken a turn for the worse with dollar strength and rate increases. You can see that price and the 50-day were moving up, but under a declining 200-day moving average. The 50-day recently crossed over the 200-day moving average, but is following price down. Barring a sudden reversal in the dollar and improvement on the chart, we're better served owning stocks or the SPY. Again, you see the reverse with price rising, RSI entering bullish overbought territory, and MACD making a new high. Now we'll switch gears to our week in review, where we take a look at the headlines and how they move the market. On Monday, stocks rose ahead of the U.S.-North Korea summit, but trading was really on hold for policy guidance from the Fed, the ECB, and the Bank of Japan. On Tuesday, we got CPI, or inflation data, that was in line with expectations. On Wednesday, the Fed raised rates as expected and guided for 2 additional rate increases for 2018. The initial reaction of the market was to sell off in the face of more hawkish guidance and concerns over policy missteps by the Fed. In hindsight, market participants are perceiving a somewhat underlying dovish tone in Powell's statements. On Thursday, the European Central Bank signaled that it would end QE in December, which pushed European stocks higher. The biggest impact on the markets came on Friday from the announcement of U.S. tariffs on $50 billion of Chinese goods, which knocked the Dow down triple digits. The S&P recouped much of its losses by the close to finish down 0.57%, and for the week, the S&P was down 0.38%. You can see the monthly and year-to-date statistics in the lower right. To put these moves in context, here's our daily chart of the S&P. Note this rounding in price action here. This is of some short-term concern. We had weaker candles as we approached overhead resistance. If you recall from last week, we suggested that price might initially follow a path like this and decline. You'll notice that the 20-day moving average has been added to this chart in pink, and moving averages can act as support. If the path resolves to the upside, we'd like to see price bounce off the 20-day moving average like this and clear resistance, come back and retest it so that the resistance becomes support. Looking for additional signs on this chart, RSI in the upper pane did clear the center line and successfully retest it, which is bullish. It would have been nice for RSI to move into the overbought zone above 70, but instead we see it turn down slightly, which deserves our attention in the short term. MACD or MACD at the bottom of the chart also shows slowing, which could result in a short-term bearish cross. Remember, we trade weekly and monthly charts. Daily charts are valuable for identifying good entry points for new positions. In fact, we used the sell-off today to enter 2 new positions. We'll finish the week with a weekly chart of the S&P. Again, you see overhead resistance, and this week's candle is a small, indecisive candle. Indecisive candles take on more significance near lines of resistance. In this case, the probability is higher for short-term weakness, given that the moving averages are still up and show a strong bullish trend. The other indicators on the chart confirm these probabilities. we see that RSI in the upper panel continues to make higher highs in the bullish zone. MACD has made a bullish cross, and Williams %R is in the bullish overbought zone. Overbought for long-term traders should not be construed as a negative. Overbought can stay overbought, as you see here from September 2017 through late January 2018. The markets digested a lot of significant news this week, from North Korea to central bank policy statements from the Fed, the European Central Bank, and the Bank of Japan, concluding with the tariff announcement. The dips created this week were bought, and it appears that market participants view the trade dispute as posturing and negotiating tactics, and they are anticipating a positive resolution. Our job is not to predict, but to follow our process, observe the probabilities, manage risk, and trade the evidence on the charts. We go into next week with the confidence that our model measures the net aggregate opinion of all market participants. We're ready for the next tweet, reciprocal tariffs from China, or any other event. When we begin to see a deterioration in the long-term trend, we'll incrementally shift into defensive assets. Until then, the longer-term evidence and the probabilities lean bullish. The information in this video cannot address the specific investment objectives, financial situation, or particular needs of any viewer. The information presented is solely for informational purposes and is not a solicitation or offer to buy or sell any security or financial instrument. None of the information in this video should be taken as investment advice. Any opinions expressed in this video are subject to change without notice. Caliber Capital Management, LLC, or KCM, is not under any obligation to update or keep the information contained in this video current. KCM, its officers, employees, or clients may have an interest in the securities, related securities, or derivatives of the securities referred to in this video. KCM accepts no liability whatsoever from any loss or damage of any kind arising out of the use of all or any part of this material. KCM recommends that you consult with a licensed and qualified professional before undertaking any investment decision.